Hello, everybody, and welcome to the Like a Tortoise channel once again. And today I want to talk about the potential market crash coming in 2026. So, if you are passionate about the markets, then you probably hear about a very soon to happen market crash in 2026 because of valuations, because of all that noise. And so the point of today of this video is to discuss whether or not I think those. Those concerns are warranted in what I'm doing with my own money, right? After all, if you guys are following the channel, that's because you want to hear that, right? You want to hear that, you want to hear my take. So, or this happens if you've been following the markets for a while, then you have probably found yourself getting caught up in all the noise, especially if you read red lines about stock market crashes and all of that. There's many people talking about that, and then we have the economists actually making predictions saying that the market has a 10% chance of a 30% crash. I have no idea how these people actually model those things. I mean, to me, it just sounds so ridiculous because the world is full of uncertainties, right? So the world is full of uncertainties and it's impossible for you to model like an upcoming crash and actually say very accurately there is a 10% chance of a 30% crash. I mean, it's so ridiculous in my opinion. But you see many well-meaning, very smart people actually putting out these predictions, and so if you guys know me, then you know that I don't make any investment decisions based on the macro outlook, okay? Because, and I believe Warren Buffett said that, and please bear with me here. He said something like, if you don't buy a business with a margin of safety, then you need to pay attention to the company and to the economy. But if you buy a business with a significant margin of safety, then the business is everything you will ever need to care about. And it makes a lot of sense. It's exactly because we don't know what is going to happen to the economy and to the company itself, right? There's only so much that we know, even though as we try our best to do as much due diligence as possible. We are not the CEOs. We are not part of the management team. And so we don't know exactly the business in and out. Like a CFO or a CEO will be able to tell you, okay? And that's precisely why a margin of safety is so important, all right? And so that's it. But I want to talk now a bit more about why I think there is reason to be concerned to some extent, especially if you are an index investor. And if you can go back to previous videos of mine here, and I actually walk you through important data, which I want to cover today as well. Okay, so there is no um, there is no doubt that the market's valuations is still very, very high. Okay, and so I'm gonna start by walking through a series. I'm gonna start by walking you through a series of charts. I'm a very visual person, and I really like to understand macro factors, even though I don't really factor them into my investment decisions. I like to be attentive to what's happening as as someone who always seeks education. And you can see that, for example, based on a couple of valuation metrics, like the Shiller P ratio, for example, you can see that we are currently at ridiculously high levels. Okay. And now, as I mentioned, you can make the case that the Shiller P, has been very high ever since 2008, right? Which is ever since 2008, this thing has been going up, and it's been trading well above the long-term average forever. But that doesn't mean it's going to continue to move up. Okay. What it means is, remember, it's always a probabilities game. So are the probabilities higher? What do you think are the most likely outcome? That the P is going to continue to go up, or that at one point this thing is going to roll over? I think it's definitely the latter. But yeah, and so again, it's about probability. So index investors, in my opinion, and I've made this very clear, are going to have a very rough couple of years ahead. Okay. And so another thing that I want to show you, apart from the Shiller P, which I already discussed, is the Buffett Indicator. The Buffett Indicator. So you just do the market cap divided by total GDP, right? So the value of all publicly traded companies divided by GDP ratio. In this, again, we are just discussing the American indexes, right? Because all of you guys are all piled into these things, into many of these indexes. So I'm just telling you exactly how I feel about it. You can see that this is also at historically high levels, well above their mean, and this has been going on for a very long time. But still, that doesn't mean it will continue to go up. At one point, it should roll over because I believe reversion to the mean does occur, and when it does happen, it's going to be nasty. Okay, so all of you chasing the next high flying stock, the next high flying tech companies are going to be very concerned if at one point this happens. And people have no idea. But for example, I'm a very conservative investor, but the matter of fact is that I haven't started investing back in 2008, 2009, which was the last time we had a significant recession in the real bear market. But ever since those years, the stocks have always been going up and up, especially with the easing of monetary policies in the well, central banks all over the world just pouring money into the economy and propping up asset bubbles, which, in my opinion, is what's happening. But and so at one point, I think the air will come out of that bubble and it's going to be nasty. So, but if you stick with the framework, okay, that already accounts for those risks, then I think over the long term you will be well in your way to making to being far better off. Okay, than a lot of compared to many of these people who are just chasing the next flying tech names. So, for example, look at this. I mean, this is incredible. Look, a divided US market, tech companies with no revenues or profits are flying, as are the Max 7. The rest are left in the shade. You've probably noticed this, that many companies with great fundamentals that are profitable, growing revenues, but that are not tech names, especially those outside the AI play, have been lagging substantially. And so people seem to be more prone, right, to following the companies that are just making promises about future returns without actually having anything to show for them yet. Yeah, look at that. Nasdaq with no revenues. These companies are just going ballistic. Okay, this is a very speculative market, and this is not going to end up. Is not going to end well. That's one thing that I know for sure. And then if things really happen, as I think they will, but again, don't take my word for it. Look at this chart. This is the S&P going back to the late 20s. You can see that there are many periods in history where you had to wait over 10 years just to break even. Okay, right now, I mean, we are in the longest bull market in history, and it's been the strongest bull market in history as well. And so I believe the next bear market is going to be one of the toughest ones in our history as well. But you don't even need that to happen because things are so overstretched right now that at one point, if this thing rolls over, even if it crashes like 20-30%, many of the S&P's constituents will be down 60-70%, and many of your many investors' accounts will just blow up. Okay, so make sure that that you stick with the framework that actually works and don't use any leverage. But the point here is that since we've been going straight up since 2008, 2009, I think the next 10-15 years are not going to be the same. If you believe that, then you are actually falling into recency bias. And I discussed this in my previous videos as well, so please go back to them. And the recency bias is where you believe the next, just because we had great years, right? Next 10 years have been great for index investors. The next 10, 20 years are going to be equally great. And then you forgot, yeah, to look back, to look back further and actually see that there are many periods in history where your money didn't do anything. Okay, look at this: 25 years to break even. Can you imagine if you are in your 20s today and if you are investing in the index? Can you imagine waiting 25 years or 17 years, or 9 years or 12 years just to break even? I mean, that's horrible. But yeah, it's just what it is. So these are some of the things that I want to show you. On top of that, on top of the high valuation levels that we have right now, certainly among the benchmarks, like among the indices, the S&P, the Nasdaq, and so forth, you can see that we also have one of the periods of higher market concentration in history. Look at this: market cap of the largest stock relative to the 75th percentile stock. You only had this level of concentration once, and that was in 1932. Okay. Every time we had such periods of concentration, high concentration, look what that led to. Okay. And look where we are right now. And you guys know this. You guys know that the concentration is quite high because top 10 stocks the top 10 stocks, which is the Magnificent Seven, okay, they actually were responsible for 38% of the S&P 500 for the S&P 500 returns in June 2024. Okay, that is staggering. So the level of concentration among big tech companies is very, very high. What will happen when that starts to shift? Okay, so another thing that to keep you you know, another thing to have you at least think about these things. Like I said, my goal with this video is not to spread fear. Not, of course not. I don't do that because, like I said, I'm not a macro analyst, but I like to pay attention of stuff. It's not going to change my framework because my if you follow this framework, you're going to make money whether the market is flat, going up, or going down. Okay, because if the S&P is outperforming, if the S&P is doing very well, you will be able to outperform regardless. But then if the S&P crashes, I think the gap between your performance in the S&P is going to widen. And this is what we saw, for example, with Warren Buffett's portfolio, for example, in the 70s, in the 80s, while the market was actually facing a lot of pressure, Buffett was making a ton of money, okay, because people then became more conservative with the way they were investing capital, okay? So guys, this is it. And on top of that, look at this. The consumer sentiment has been flushed out as well. Look at that, at one of the lowest levels since the early 80s. So the consumer sentiment is low. However, they are still spending, which is an interesting dichotomy. But typically you can make the case that every time consumer sentiment was this low, then I mean, it actually turned around, right? And it started becoming better. But this is, again, just data for you guys to digest. And yeah, man, don't forget that in 2026, I don't know if we're going to see that recession, as many economists are calling for. But what I do know is this: you should be very. Look, I'm not going to use the word happy because that may sound nasty. If we do get into a recession, a lot of people will struggle. You will see companies going under. You will see a lot of people struggling, having to sell their assets at a losses. They will get margin calls. It's nasty. However, from a purely investment standpoint, this is what's going to allow us to make the most money. We are planting the seeds for the next bull market. Okay, and look what happened right here. The best days in the stock market often take place after the worst ones. Okay, this is very important. You can see that after every nasty bear market, there is a very strong bull market. And so bear markets may last longer than others, of course, same thing with bull markets, but the longer the longer they take, the more opportunities you will have to actually plant the seeds. And the beautiful thing about investing in well established and high quality businesses, guys, is that they will consolidate. They will be able to buy, like some of the competitors in times of distress. They will buy their assets on the cheap, and that will give them very power as well. And so, you see, this is the thing. And you are, because by sticking with great companies, these are companies that have already proven themselves. You can look at how they performed during past bear markets, and you can see that they have lived through many of them. Okay, so they have a proven business model, proven history, and these are the things that we want to put our money into, because no matter what, they are going to come out of those gloomy days stronger. Okay, so guys, if you enjoyed the video, just smash that like button, share it with your loved ones, people that are actually adore the markets, and let me know if there is anything in particular you'd like me to discuss in the next videos, and stay tuned for more.